Let's bring in today's market panel. Kevin Kelly from Benchmark Investments, Heather Zumarraga from Vision 4. Heather, let me start with you. It seems like there are at least two major things that are driving this sell-off. One of them is the Fed chickens coming home to roost. We've had loose monetary policy forever and ever and ever, and it looked like we were never going to have to pay for all that money. And right now, the prospect of interest rates going up is having a huge effect. Also, all the spending going on in Washington also having an impact on interest rates, all that pressure on the Treasury putting pressure on stocks. What do you think?
Yeah, you got it. It's no coincidence that the start of the sell-off on Monday happened on new Fed Chair Jay Powell's first day.
No, it's not a coincidence.
After Yellen. I don't think it is either. And although he is supposed to continue Janet Yellen's policy, so it shouldn't be a surprise to the markets, the fact is the certainty is not there anymore. We don't have a floor in the market, so to speak. I think they used to call it the Greenspan put, and then we had a Yellen put, meaning if the markets were to go down, the Fed was going to help prop them up with all this easy money. We have printed over $12 trillion, and all central banks around the world. Party's over. There's no subsidy anymore in this market, so I know corporate earnings do matter. I know the tax cut is huge, but guess what? This sell-off started on Monday when new Fed Chair Jay Powell's in office, and that's no coincidence.
Yeah, absolutely. I mean, Kevin, you know, the Fed punch bowl, the Obama punch bowl is gone. And that's what we're seeing a lot of the reaction to, plus all of the spending. What do you think?
Yeah, I think that's a good point. I mean, the Fed artificially suppressed interest rates and volatility in the markets, and now we're seeing it come back. And this is a normal thing. The Fed basically blew out everybody's expectations when it came to chasing returns, and now here we are. We're trying to balance risk, figure out what's going on. I think it's important to note, though, when you see a sell-off like this, one of the biggest buyers of stocks is not in the market, and that's the companies themselves, because there's a blackout period due to earnings. So when that blackout period is over, you're going to start to see stocks come up, because if you're a CFO, this is your best chance of buying your stock at the cheapest level in 2 months.
So a lot of people are quick to point out that a lot of this has to do with growth in the economy. We're seeing those tax cuts. It's all good news. And some of those, you know, the talk of growth is what kicked off the fears about interest rates. At the same time, Heather, if interest rates go up, does it eat into those new corporate profits for the companies who got the tax cut because the cost of borrowing is higher, or do they have enough cash it's not that big of a deal?
The cost of capital will go up, and the dollar is weaker as well. And I don't think inflation is just sparked by the wage growth of 2.9%. I think that's more of a tight labor market issue. Yeah. But the dollar is weaker from a systemic standpoint. And look, not just analysts and investors, but President Trump himself is tweeting that, hey, good news in the market is now bad news, and bad news may be good news. We were there a few years ago when every time the Fed said that they're going to supply more easy money to the markets, and here they are taking away the punch bowl, and now potentially good news for the markets, at least, is bad news right now, especially today, down over 1,000 points.
So, Kevin, I guess then the result, the end of that whole conversation is, what are the chances that the market stabilizes, that it just adjusts to the idea of a new higher interest rate market balanced against the backdrop of a stronger economy? Maybe the government is spending a lot more, but you heard our own Blake Berman ask at the press conference, what about the fact the government's spending so much? The response from the podium was, the White House is going to come back with its own budget on Monday, and we're not just, you know, spending like drunken sailors or, you know, whatever. There's going to be some. There's an end in sight. Yeah, I know, Kevin. So what do you what do you think about my Goldilocks scenario that I'm trying to paint there?
I love your Goldilocks scenario, because one of the things you need to consider is that we haven't had a 5% move for over 410 days, and we're finally getting it now. And that's because the market is trying to recalibrate what earnings metric we're going to be at. So we were trading at 20 times earnings, then 17 earlier this week. So the market's trying to assess what's the right multiple and valuation for this market, given that there's two rising costs that are going to be embedded in that E in PE, and that's rising labor costs and rising debt costs. And so the market's recalibrating risk right now.
All right. Heather, what do you think about that?
I think the market is recalibrating risk, and you know what? Push the markets into capitulation today and to close. I think when we broke through Monday's low, I think you see these algorithmic trading. Man, let me put it simply for the retail investor. They're computer programs. Yes, you have rules-based strategies set up. One of them may be certain levels in the S&P 500. the price of oil, or the volatility index, better known as the VIX, that fear gauge. And when we hit those levels, you have these computer programs, these computer models step in, and there's massive selling, and these models react a lot quicker than the retail investor can. So my best advice for the retail investor is to be very cautious here. I think there's actually more downside to come, Melissa.
And it creates volatility, even though in the last hour we heard the chairman emeritus of Virtu say that that wasn't the case, but sure seems like it is. Thanks, guys.
It sure is.